One bad decision during an IRS audit can cost you thousands of dollars, even if every deduction on your return was legitimate. I've seen taxpayers lose audits when they should have won. I've seen simple examinations spiral into much bigger problems. And I've seen one altered receipt nearly transform a routine audit into something far more serious. The truth is that most people completely misunderstand how IRS audits actually work. They think audits are about proving whether someone cheated. They're not. Most audits are won or lost based on something much simpler: documentation, strategy, and the decisions you make after the audit begins. Today, I'm going to show you several IRS audit secrets most taxpayers never learn until it's too late, how audits are really won and lost, and what you can do to protect yourself if the IRS comes knocking. And stay with me because later I'll show you a real case where one taxpayer made a decision in less than 30 seconds that nearly changed the entire direction of their audit. I'm Brad Paladini. I'm a tax attorney and founder of Paladini Law. My team and I help individuals and business owners navigate IRS audits, resolve tax disputes, and protect themselves from costly mistakes. One thing I've learned after years of dealing with audits is this: the taxpayers who lose audits aren't always the ones with the worst facts. And the taxpayers who win audits aren't always the ones with perfect records. The outcome often comes down to understanding how the process works, avoiding a handful of critical mistakes. That's because audits are rarely won with arguments. They're usually won with preparation, organization, and strategy. So let's pull back the curtain and talk about some IRS audit secrets most people never hear about. Audit secret number one: the IRS starts with an assumption. Most people don't realize when an IRS audit begins, the IRS generally starts with the assumption that the information on your return must be supported. That may sound obvious, but this is where many taxpayers get into trouble already. They assume the IRS has to prove they're wrong. In reality, the burden often falls on the taxpayer to prove that they're right. If you claimed a deduction, you generally need to support it. If you reported a business expense, you generally need documentation. If you claimed a tax credit, you need evidence that you qualified. The audit isn't usually about what happened. It's about what you can prove happened. And that's a very important difference. Think of it this way: if two taxpayers have the exact same deduction, but only one has records to support it, they may end up with completely different audit outcomes. The IRS can't evaluate what isn't documented. Audit secret number two: records matter more than explanations. One of the biggest mistakes taxpayers make is believing a good explanation can replace documentation. It usually can't. I've seen taxpayers give completely truthful explanations that were rejected because they couldn't provide supporting records. The IRS may ask for receipts, bank statements, mileage logs, invoices, contracts, proof of payment. And when those records don't exist, even legitimate deductions can become difficult to defend. So the lesson is simple: documentation often carries more weight than memory, because during an audit, evidence beats explanations. And that leads directly into a case that perfectly illustrates what can happen when someone with missing records handles it the wrong way. Let's go through a real example. I changed the facts a bit just to protect confidentiality, but the gist of it is there, okay? The taxpayer received an audit notice and decided to handle everything on their own. At first, that wasn't necessarily a problem. Many taxpayers successfully handle audits themselves. The problem was how they handled it. The IRS requested documentation to support certain deductions. The taxpayer couldn't find all the records they needed. So at that moment, they had several options. They could explain the missing records. They could try to reconstruct documentation. They could look for alternative evidence. Instead, they made a decision that took less than 30 seconds. They used software to alter one of the receipts before submitting it to the IRS. Now, think about that for a second. The original audit was about whether certain deductions could be substantiated. After the altered receipt was submitted, the issue was no longer just the deductions. The issue became whether the taxpayer had intentionally provided false documents to the government. And that's a completely different conversation. As the audit continued, the IRS identified inconsistencies with the documentation. Questions started multiplying. Additional information was requested, and the auditor's focus changed. What began as a routine substantiation issue became a credibility issue. Eventually, the taxpayer was required to explain the records that had been submitted. They had to do this in person in front of IRS counsel. This is what nobody understands. The tax adjustment itself was not the biggest risk. The altered document created the bigger risk. What started as a civil examination suddenly became raising questions that no taxpayer wants the government asking. Fortunately, the matter was ultimately resolved without criminal charges, but it became dramatically more serious, more expensive, more stressful than it needed to be. And the lesson is simple. If a document doesn't exist, don't create it. If a receipt is missing, don't alter one. If records are incomplete, address the problem honestly and strategically. A weak fact pattern is usually easier to manage than a credibility problem, because once an auditor starts questioning whether the information you're providing can be trusted, every part of the case becomes harder. Audit secret number 3, auditors often follow patterns. Many people imagine IRS auditors randomly digging through every aspect of their finances. That's usually not how it works. Most audits start with a specific issue. Maybe it's unusually high business expenses. Maybe it's large charitable deductions. Maybe it's a Schedule C loss. Maybe it's unreported income. The auditor often starts by focusing on that issue. But here's the secret. If they find significant problems in one area, they may start looking more closely at others. That's why small issues can become bigger issues. One unanswered question can lead to additional questions. One unsupported deduction can lead to requests for additional records. That's why preparation matters so much. The goal isn't just answering the first question. The goal is preventing the audit from expanding. And later, I'll explain how experienced professionals approach that challenge differently than most taxpayers. Audit secret number 4, the first response often sets the tone. Here's something many taxpayers don't understand. The first response can shape the entire audit. When the IRS requests information, some people send everything they own. Others send almost nothing. Both approaches create problems. Sending too little may make it look like you're being uncooperative. Sending too much may provide information that creates new questions. This is what many taxpayers miss. An audit is not simply about responding, it's about responding strategically. Every document should have a purpose. Every explanation should have a specific question. Every submission should move the case towards resolution. That's very different than simply dumping paperwork on an auditor's desk. Audit secret number 5, most audits never become criminal cases. Let's address one of the biggest fears people have. They hear the word audit and immediately think they're going to prison. For the overwhelming majority of taxpayers, that's not reality. Most audits are civil examinations. The IRS is generally trying to determine whether the amount of tax was reported in. Criminal investigations are relatively rare and typically involve evidence of intentional fraud, tax evasion, or more serious other conduct. That's important because fear causes people to make bad decisions. Some people stop communicating. Some people destroy records. Some people panic and say things they shouldn't. The better approach is to understand what type of case you're dealing with before assuming the worst. And that's where professional guidance can make a significant difference. So here's how an experienced tax professional typically approaches an audit. They don't immediately start arguing, and they don't immediately start providing documents. First, they identify exactly what issue triggered the audit. Then they determine what information the IRS is actually requesting. Then they review the available documentation. Then they evaluate the strengths, weaknesses, and potential risks. Only after that do they develop a response strategy. Notice the pattern. They're not reacting emotionally. They're working through a process. Most taxpayers operate from fear. Professionals operate from strategy because successful audits are usually won through preparation, organization, and planning, not panic. If you're facing an audit, here are 5 things that you should do. First, read every IRS notice carefully. Don't assume you know what the IRS is asking. Second, identify the specific issues being examined. Know exactly what the audit is about. Third, gather documentation before responding. Organize records before you submit anything. Fourth, answer the question being asked. Avoid providing unnecessary information. And fifth, develop a strategy before engaging. Understanding your position, your evidence, and your options before moving forward. Each of these steps helps you stay in control of the process. If you need to, pause this video and screenshot this checklist. These 5 steps alone can help you avoid many of the mistakes that cause audits to become more difficult than they need to be. The biggest audit secret isn't hidden in some IRS manual. It's this. Most audits are not won or lost because of one dramatic mistake. They're won or lost through dozens of small decisions. How you organize your records, how you respond, how quickly you act, how strategically you communicate. Remember the taxpayer who altered the receipt. The audit didn't become dangerous because of the deduction itself. It became dangerous because of a decision made during the audit process. The taxpayers who understand this often put themselves in a much stronger position than those who simply react as problems arise. Because an audit is not just an examination of your tax return, it's an examination of your ability to support what you reported. And that's something you can prepare for. If you've received an IRS audit notice and you're not sure what to do next, don't assume the situation will resolve itself. Small problems have a tendency to become expensive problems when they're ignored. We offer consultations where we review your audit notice, identify the issues being examined, evaluate potential risks, and help you determine the best path forward. You can use the link below to schedule a consultation. And if you want to understand how the IRS really operates, not how people think it operates, subscribe to the channel. Every week, I break down IRS audits, collections, tax debt, tax resolution strategies, and the hidden rules that affect everyday taxpayers. Thanks for watching, and I'll see you in the next video.